Hi, Tim Shapter back again from Smart SMSF Solutions. So hopefully you've watched the first video, which gives us a general overview of what superannuation is. So in this video here, we're going to talk specifically about a self-managed super fund and how it can buy an investment property using the bank's money. So in the previous video, we showed super as a bucket. So this is our bucket in this case. So this is our self-managed super fund. And let's put a value on that super fund of $120,000. So that's the balance in the super. So with a self-managed super fund, it is a trust, so therefore we need a trustee, and we always use a company trustee. And look, there's a few reasons for this. The first one is simply it does provide better asset protection for the members of the fund, which ultimately would be us. And also it does provide a real streamlined estate planning point to the self-managed super fund, which is often forgotten, but very, very important. So we have a company trustee, of which the members of the super fund would be the directors and shareholders. So we can have up to 4 members in a self-managed super fund. Okay, so we've got our self-managed super fund and we're ready to start investing, and we're more comfortable with property. We don't really understand shares and manage funds. And I always say to people, if I wrote you a check for $120,000 and said you had to invest it, it's your money, but you have to invest it, what would you be more comfortable investing in? Shares, managed funds, or using that money to buy an investment property? And I guess 99% of the time, clients will tell me they would prefer to have an investment property. They like the hard assets, property and cash. So here we've got our trustee has said, okay, we've got to invest our money, let's go and buy an investment property. So the super fund sees a property, and let's say $400,000. So obviously the super fund doesn't have enough money to purchase the property outright, so this is where the bank comes in. So we've got our bank here, and it's happy to lend money to the super fund. So let's work out how much it has to lend. So here we've got $120,000. We need a deposit, typically 20%. So we need $80,000. We need to cover costs to purchase that property, and also I like to cover the cost of setting up the self-managed super fund. So let's allow $20,000, and again these are just assumptions, but they'll be fairly close. And I always recommend, in fact insist, that we have $20,000 in cash, which is just good risk management. If you're going to be the trustee of the fund, you're responsible for the risk, so therefore we say $20,000 will be nice and comfortable. So we've got $120,000. So in this case we have enough money to complete the transaction, provided the bank lends the super fund $320,000. Now in this case it's the super fund that's borrowing the money, so therefore the super fund's responsible for the repayments. And really that's the first benefit of having a self-managed super fund with an investment property. In the majority of cases, it's not going to use any of our current household income to have that investment property. And I guess to simplify that down, what we're saying is if you've got, in this case, $120,000 in super, you can put it into a self-managed super fund and have an investment property that isn't going to put you out of pocket in your personal household cash flow. Now that is a great benefit. So what the super fund is going to use to repay that is rent from the property and also employer contributions. So the employer contributions and the rent are used to make the repayments to the bank. Now the super fund, just like we are in our own names, is entitled to claim the interest to the bank as a tax deduction to the super fund, and also depreciation on the property. Remembering that property we can claim fixtures and fittings between 5 and 10 years, and also depreciation of the actual building at 2.5% over 40 years. So the super fund gets the benefit of that. So just to recap, self-managed super fund, we always use a corporate trustee. We need to cover deposit costs and have a cash buffer there of $20,000 as a minimum. And the bank will lend the super fund the balance to make the purchase complete. And the super fund alone is responsible for those repayments and also the costs. And we use the rent and the employer 9% to make those repayments. The interest is tax deductible, and so is the depreciation on the property. Now, the whole reason that this actually works is because of the loan arrangement between the bank and the self-managed super fund. So commonly called limited recourse borrowing arrangement, or you may hear it called a non-recourse loan. Both work. But what that really means is that the bank only has recourse over that property if the self-managed super fund were to stop paying the bank repayments. So again, the type of loan actually allows this whole process to happen and become legal under the legislation because of the type of loan. So in this case, if the super fund for whatever reason stopped making the repayments to the bank, then the bank only has recourse over that property. It can't actually touch any of the other assets in your own name or companies or trusts or anything like that. So provides really good asset protection. So the 2 points there are really good asset protection, and this arrangement does not affect your household cash flow. Really important. Now, the way that we actually make this loan a non-recourse loan is simply using a bare trust. So some people call them a holding trust, custodial trust, but basically what it is it's a bare trust. It doesn't receive income or capital gain, and it simply holds the legal title over that property until such time as the loan is repaid, in which case we get rid of the bare trust and the property becomes an asset of the self-managed super fund as the legal owner. Again, whenever we set up a trust, we always use a company trustee. And again, that's really for the protection of the members of the fund, and certainly protects the members of the fund in their personal names as well. So I hope that explains a self-managed super fund and how we use the bank's money to purchase an investment property inside a super fund, and really explains the cash flow that the employer contributions and the rent is what's used to pay back the bank. Now, a couple of things about the property. The first thing is it has to be a single contract property. So what I mean by that is either an existing property or a brand new property that's a house land contract. So one contract is the rule there. The other thing about the property, unfortunately, we can't buy a property in the self-managed super fund and rent it to our kids or our brother or sister. It comes under the related party legislation, which disallows that. And obviously we can't move into that property as well. So we can't go and buy a holiday home in our self-managed super fund and have Christmas holidays by the beach. So again, the next video I'm going to do an example of how the numbers work with a property in a self-managed super fund. So please watch that. It actually is fairly exciting. And I thank you, and I look forward to meeting you shortly.